Hey everybody, Crypto Ninja here, and for our Crypto Trading 101 series, we'll be starting off today with a beginner's guide to candlesticks. Firstly, we'll be covering the anatomy of a candlestick. A candlestick represents the price activity of an asset during a specified time frame through the use of four main components: the open, close, high, and low. The open of a candlestick represents the price of an asset when the trading period begins, whereas the close represents the price when the period has concluded. The high and the low represent the highest and lowest price achieved during the same trading session. Now we'll be covering the physical features of a candlestick. Every candlestick uses two physical features to display the four main components. The first feature, known as the body, is a wide midsection of the candlestick, and it depicts the open and close during the observation period. Most charts will allow you to set the range for the candlesticks. The close is represented at the top of the body in the green candlestick and at the bottom of the body in the red candlestick. On the opposite is true for the open, which forms the bottom of the green candlestick and the top of the red candlestick. The final two components, the high and the low, are represented in the second feature of the candlestick, known as the wick. Wicks are simply displayed as a thin line extended above and below the body of the candlestick. Cryptocurrency traders tend to take advantage of the inherent market volatility by using charts on the intraday timeframes. Each candlestick typically represents 1, 2, 4, or 12 hours. A longer-term trader would likely choose to observe candlesticks that represent a single day, week, or month. A candlestick becomes bullish, typically green, when the current or closing price rises above its opening price. The candlestick becomes bearish, typically red, when its current or closing price falls below the opening price. A candlestick rarely keeps its figure for too long in the volatile cryptocurrency market. For instance, if the 2-hour candlestick opens at a price of $10 and jumps to $13 an hour later, the shape of the candlestick will have dramatically changed since opening. But traders have also come to realize that the same candlestick shapes occur at the same stage of a price trend, no matter what is being traded. It can be very lucrative to identify such formations because they can expose clues as to when a trend might reverse, continue, or when market indecision is at its peak. Three of the most useful candlesticks for identifying a potential trend change or a gouging market sentiment are the doji, hammer, and shooting star. The doji is a prime example of what traders mean when they say a candlestick represents human emotion or market sentiment. When the asset price swings in both directions before closing near its opening price, it is clear the market is indecisive about the asset's true value. The classic doji candle, representing an indecisive market, comprises equal length wicks and a very thin, centrally located body. Further, there are several variations of doji which signal trend exhaustion, trend reversal. A hammer is a precursor to a potential downtrend reversal and can be a big moneymaker for the bulls. Hammers are formed when price sinks below the open, only to return later and then close above the open. Such price action signifies that at one point during the trading period, sellers temporarily gained control but quickly gave it back and then some, for a bullish close to the candlestick. The physical features of a hammer consist of only one wick, roughly 2 times the length of the body, which is located at the top of the candle. Last but not least, the shooting star is the exact opposite of the hammer. The shooting star occurs at the peak of an uptrend when the bulls rally to start the trading period, but eventually lose control to the bears who drag the price to a close below the open. It's important to keep in mind that the longer the duration of the candlestick, the more powerful its effect is on the overarching trend. For instance, a hammer spotted in a 1-hour candlestick will have almost no impact on a 6-month-long downtrend, whereas if the hammer formed on a 1-week-long candlestick, its reverse impact would be much more significant. And to reiterate, it's important to keep in mind that the longer the duration of the candlestick, the more powerful its effect is on the overarching trend. For instance, a hammer spotted on a 1-hour candlestick will have almost no impact on a 6-month-long downtrend, whereas if the hammer is formed on a 1-week-long candlestick, its reverse impact would be much more significant. Thank you all for watching. This has been Crypto Ninja for the Crypto Trading 101 guide series. I hope you guys have learned a lot and continue to follow the series through until the very end to become the best trader you could possibly be.